What if the biggest danger in silver isn't the price going down, but everyone rushing in at the same time? Robert Kiyosaki is sounding the alarm again, and this time it's about $200 silver. While most people are focused on how high silver could go, Kiyosaki says almost no one is paying attention to the real risk hiding underneath the hype, and that blind spot could cost investors far more than they expect. Think about this. Governments are printing money at record speed, debt is exploding, and trust in fiat currency is quietly eroding. In that environment, silver isn't just an investment, and it becomes a lifeboat. But here's the twist no one's talking about. When silver demand surges, it won't behave like stocks or crypto. Physical supply is limited. Paper contracts can vanish. Premiums can explode overnight. And when panic hits, you may not be able to buy silver at any price. Kiyosaki warns that by the time silver hits $200, the opportunity phase may already be over. The real winners are positioning before the crowd realizes what's happening. The losers? Those who wait for confirmation from the headlines, only to discover the exit is crowded and the door is closing fast. So is $200 silver a once-in-a-generation opportunity, or a trap for latecomers who don't understand the hidden risks? In this video, we're breaking down exactly what Kiyosaki is warning about, what most investors are ignoring, and how to think strategically before the rush begins. If you value insights like this and Don, who want to be the last one to know, hit the like button now. It helps the channel and tells YouTube to show you more content like this. So let's pick up right where that warning leaves off, because this is where most people get it wrong. When Robert Kiyosaki talks about silver going to $200, he's not making a flashy prediction just to get attention. He's describing a chain reaction that starts quietly, almost invisibly, and then accelerates so fast that by the time the average person reacts, the entire landscape has already changed. That's why this conversation matters now, before the headlines turn silver into a mainstream obsession, and before the risks he is hinting at become impossible to ignore. To understand what Kiyosaki is really warning about, you have to step back from the price chart and look at the system itself. Silver isn't just another commodity. It's money, it's an industrial metal, and it's a pressure valve for a financial system built on debt. For decades, silver has been treated like it's abundant, boring, and replaceable. But that narrative only works as long as people believe the paper version of silver is the same as the real thing. Once that belief cracks, everything changes. Right now, the global economy is sitting on a mountain of promises. Governments promise pensions they can't fund. Central banks promise stability while expanding their balance sheets. Banks promise liquidity they don't actually have on hand. All of this works as long as confidence holds. But history shows that confidence doesn't fade gradually. It breaks suddenly. And when it breaks, people rush toward assets they believe are real, scarce, and outside the system. That's where silver enters the story in a way most investors aren't prepared for. Kiyosaki has spent years talking about the difference between real assets and paper assets. Stocks, bonds, ETFs, and even many forms of silver exposure are ultimately claims. They are IOUs that depend on someone else's ability to perform. Physical silver, on the other hand, doesn't rely on a counterparty. It doesn't need permission. It doesn't default. And in times of stress, that difference becomes everything. The risk most people are ignoring is not whether silver can reach $200. The risk is what happens to access, pricing, and liquidity when everyone tries to get the same thing at once. Think about how silver is actually used in the real world. It's critical for electronics, solar panels, medical equipment, electric vehicles, and military technology. Unlike gold, most silver is consumed. It's used, scattered, and often unrecoverable at current prices. That means above-ground supplies are far smaller than people assume. For years, mining production has struggled to keep up with industrial demand. At the same time, investment demand quietly grows in the background, waiting for a catalyst. Now imagine what happens when confidence in paper assets starts to wobble. It doesn't take a full collapse. It could be a banking crisis, a currency shock, a debt ceiling standoff, or a geopolitical escalation. Suddenly, investors who never cared about silver start looking for it. Funds reallocate. Retail buyers rush online. Headlines talk about safe havens. But the silver market isn't built to absorb that kind of demand overnight. It's small, it's tight, and it's already strained. This is where the ignored risk becomes obvious. And when demand spikes, the price you see on a screen becomes almost meaningless. Spot prices are set in paper markets, not by people holding bars in their hands. In a real shortage, physical silver detaches from paper silver. Premiums explode. Delivery times stretch from days to weeks to months. Dealers run out. Mints ration supply. And suddenly, owning silver isn't about timing the market anymore. It's about whether you can get any at all. Kiyosaki's warning about $200 silver isn't just about upside. It's about timing and positioning. If silver reaches that level because the system is under stress, it means the move didn't happen in a calm, orderly way. It happened in a rush. And in a rush, late buyers don't get the price they expected. They get whatever is left at whatever terms are available. That's the trap almost no one talks about when they chase big numbers. Another layer of risk comes from the way people think about liquidity. Many assume they can always buy and sell when they want, but liquidity is an illusion during crises. Markets that look deep and stable can freeze in hours. We've seen it with bonds, with currencies, and even with supposedly safe money market funds. Silver is no different. If everyone tries to convert digital claims into physical metal at the same time, the system simply can't deliver. Not because of conspiracy, but because there isn't enough metal to match the paper promises. This is why Kiyosaki constantly emphasizes education over speculation. He doesn't want people piling into silver because a price target sounds exciting. He wants them to understand why silver matters, how it behaves under stress, and what role it plays in protecting purchasing power. $200 silver is not a victory lap. It's a signal that something much bigger has gone wrong in the monetary system. There's also a psychological risk that rarely gets discussed. When prices move fast, emotions take over. Fear of missing out pushes people to buy at the worst possible moments. At the same time, fear of loss paralyzes rational decision-making. People who never planned a strategy suddenly find themselves reacting to headlines, influencers, and social media noise. In that environment, mistakes multiply. People overpay. They buy fake products. They trust the wrong intermediaries. They chase leverage. All of that risk compounds when the asset in question is already scarce. Kiyosaki's critics often accuse him of being overly dramatic, but drama isn't the point. The point is preparedness. He's seen cycles repeat over and over. Easy money leads to complacency. Complacency leads to fragility. Fragility leads to shock. And shock leads to a scramble for safety. Silver sits at a unique intersection of affordability and utility. It's cheap enough for average people to buy, but critical enough that institutions can't ignore it. That combination makes it especially volatile when sentiment shifts. Another overlooked factor is trust. Financial systems run on trust, not math. When trust erodes, people don't slowly rebalance portfolios. They move decisively. They pull deposits. They convert currency. They demand delivery. In those moments, the rules change. Contracts get rewritten. Redemptions get suspended. Limits get imposed. None of that is theoretical. It's happened repeatedly throughout history in different forms in different countries. Silver AES' role in those moments has always been the same, a tangible store of value when promises fail. So when you hear $200 silver, don't hear it as a guarantee or a target. Hear it as a warning signal. A signal that the gap between paper wealth and real wealth is widening. A signal that the cost of waiting may not be measured in dollars, but in access. A signal that the biggest mistake might not be buying too early, but buying too late. This doesn't mean silver is a magic solution or that it replaces common sense. It means it deserves serious consideration in a world where financial complexity hides real risk. The ignored danger is assuming normal conditions will persist forever. They never do. And when they change fast. Silver doesn't move gradually from calm to chaos. It jumps. And those jumps are what catch people off guard. As we move deeper into this decade, pressures are building everywhere at once. Debt levels are higher than ever. Interest costs are squeezing governments. Political divisions are intensifying. Supply chains remain fragile. Energy transitions require massive amounts of metals, including silver. All of this adds stress to a system already stretched thin. You don't need a single catastrophic event. You just need enough strain that confidence starts to slip. Kiyosaki's message, beneath all the noise, is about personal responsibility. No one is coming to save your purchasing power. Central banks protect systems, not individuals. Governments protect stability, not savers. In that environment, understanding assets like silver becomes less about speculation and more about self-defense. The risk everyone is ignoring is assuming someone else has it under control. And here's the uncomfortable truth. If silver does reach $200, the conversation won't be about how smart early buyers were. It will be about why so many people didn't act when the warning signs were clear. It will be about shortages, controls, and regret. That's not meant to scare you. It's meant to wake you up. Because awareness is the first step toward better decisions. So as you think about silver, think beyond the chart. Think beyond the hype. Ask yourself what role it plays in a world where trust is fragile and promises are plentiful. Ask yourself whether you're relying on systems that have already shown their limits. And ask yourself whether waiting for confirmation might actually increase your risk, not reduce it. This conversation isn't about predicting the future with certainty. It's about recognizing patterns that have repeated for centuries. Currency debasement, debt expansion, loss of confidence, flight to real assets. Silver has been there through all of it, not as a get-rich-quick scheme, but as a quiet anchor when everything else feels unstable. Kiyosaki's warning is uncomfortable because it challenges the idea that you can react later. In reality, later is usually when options are worst. The ignored risk is complacency, the belief that markets will always be liquid, that prices will always be fair, and that access will always be available. History says otherwise. If you take anything away from this, let it be this. Silver at $200 isn't the story. The story is what happens before that number ever appears on a screen. The positioning, the preparation, and the understanding that real wealth behaves differently than paper wealth when the system is under pressure. That's the risk hiding in plain sight, and that's why this warning matters right now.